Hey there. Welcome to another deep dive. Today, we're going to be exploring a really fascinating strategy for early retirement.
Oh, yeah.
Yeah, imagine this. You retire early
Okay.
with $1 million.
Yeah.
Not by constantly checking stock prices,
Right.
but by living off the dividends that your investments generate.
Interesting.
It's all about creating this reliable stream
Yeah.
of passive income that grows over time, even during market downturns.
I like it.
Pretty cool, huh?
Yeah.
So let's dive in.
Okay.
So the core idea here is that instead of selling your shares
Right.
to fund your retirement,
Yeah.
you let the companies you invest in
Uh-huh.
do the heavy lifting for you.
Okay.
They pay you dividends,
Right.
which is essentially a share of their profits directly into your pocket.
Like having a mini business that works for you, constantly churning out cash, regardless of whether the market's up or down.
I love that analogy.
Yeah.
It really highlights the beauty of this approach.
Yeah.
You're not at the mercy of market volatility.
Yeah.
You're tapping into the steady cash flow of solid businesses.
Exactly.
But of course, there are always risks, right?
Sure.
What happens during a major economic downturn?
Yeah.
Couldn't those dividends dry up?
That's a smart question. While dividends are generally more stable than stock prices,
Okay.
they can be affected by economic conditions.
Right.
However, that's where the strategy gets really interesting.
Interesting how?
During a downturn, when others are panicking, you have an opportunity.
Okay.
Stock prices drop, which means dividend yields go up.
Yeah.
You can actually use that downturn to buy more shares at a discount,
Oh,
further boosting your future income.
that's a powerful way to reframe a downturn.
Yeah.
Instead of fear, it becomes a chance to build your passive income stream even faster.
Exactly. But of course, we need to be realistic.
Okay.
This particular strategy relies on a few key assumptions.
I like what?
We're talking about someone who is debt-free, owns their home, has healthcare costs covered,
Uh-huh.
and enjoys a reasonably moderate lifestyle.
So we're painting a picture here of someone who's financially prepared for early retirement.
Yeah.
It's not just about reaching $1 million. It's about having all the other pieces in place.
Right. And for this deep dive, we'll aim for a target budget of $5,000 per month, which translates to $60,000 annually.
Okay. $60,000 a year from dividends alone.
Yep.
Now, that's an interesting target.
It is.
Before we get into the actual portfolio,
Okay.
let's talk about hedging against risk.
Sure.
The world can throw some curveballs, whether it's geopolitical events or economic shocks.
Yeah.
How do we build in some protection against the unexpected?
This is where gold comes in.
Okay.
We'll allocate 15% of the portfolio to gold as a hedge against those unforeseen circumstances.
Gotcha.
It's a classic safe haven asset that has historically held its value during times of uncertainty.
So it's like a financial safety net,
Exactly.
a way to potentially offset losses in other parts of the portfolio if things get rocky.
Yep.
And to invest in gold, we'd be looking at ETFs like SPDR, gold mini shares, ticker symbol GLDM, or SPDR, gold shares, GLD rather.
Exactly. These ETFs offer a convenient and liquid way to gain exposure to gold without the hassle of physical storage.
Okay, so with that safety net in place,
Mm-hmm.
let's start building the core of this early retirement portfolio.
Sounds good.
What are the key principles guiding our investment choices?
Yeah.
It's not just about chasing the highest yields, right?
You're absolutely right. We're looking for a blend of high yield, of course, but also growth potential, especially dividend growth, to outpace inflation.
Uh-huh.
And just as important, we're seeking investments that are known for their stability and resilience, particularly during economic downturns.
So we're building a portfolio that can weather various storms.
Precisely. We're not trying to time the market.
Right.
We're trying to build a portfolio that can generate that steady stream of income, rain or shine.
That's a comforting thought.
Yeah.
Okay, so what are the building blocks of this resilient portfolio? What specific categories of investments are we looking at?
We'll be exploring 5 main categories.
Okay.
They each bring something unique to the table, offering a mix of high yields growth potential and that all-important stability we're after.
Okay, I'm ready to dive into those categories.
All right.
First up, we have business development companies, also known as BDCs.
Okay.
What are BDCs and why are they on our list?
BDCs are fascinating. They invest in small to mid-sized companies, typically by providing loans.
Interesting.
They tend to fly under the radar, but for income-focused investors, they offer a unique advantage.
Okay, what's that?
BDCs are structured as pass-through entities, meaning they don't pay corporate income tax. Instead, they distribute most of their profits directly to shareholders as dividends.
Ah, so that explains the high yields.
Exactly.
But are there any downsides to consider?
Sure.
High yields often come with higher risks.
You're right to be cautious. While BDCs offer those juicy yields, their dividend growth might not always be consistent.
Okay.
Their performance is often tied to the broader economy, so they can be affected by things like interest rate changes.
So it's a trade-off high yield, but potentially less predictable growth.
Right.
Got it.
Yeah.
So which specific BDCs are we considering for this portfolio?
We've identified three that stand out.
Okay.
Morgan Stanley Direct Lending Fund, ticker symbol MSDL,
Okay.
Golub Capital BDC, GBDC,
Uh-huh.
and Blue Owl Capital Corporation, OBDE.
What makes these three stand out from the crowd?
Each of these BDCs has a solid track record, a conservatively managed portfolio focused on senior secured loans, and they're currently trading at a discount to their net asset value.
Wait, a discount.
Yeah,
Does that mean we're getting a bargain?
it does. You're essentially buying $1 worth of assets for less than $1.
Oh, wow.
And all three offer dividend yields around 10%, which is quite impressive.
10%. Now that's what I call a high yield.
Yeah.
But can they actually sustain those payouts?
That's a valid concern. But these particular BDCs have a comfortable cushion.
Okay.
Their dividends are well covered by their net investment income, with a margin exceeding 20%.
That cushion is reassuring. It means they have some wiggle room to handle potential challenges without cutting their dividends.
Exactly.
Okay, so BDCs bring that high yield element to the table. What's the next category on our list?
Next, we'll venture into the world of real estate with real estate investment trusts, better known as REITs.
REITs. Those are always a hot topic. Why are they a good fit for an early retirement strategy?
REITs are known for their stability and their tendency to hold up well even during economic downturns.
Okay.
They invest in real estate, a tangible asset that's always in demand.
Makes sense.
And like BDCs, they're structured as pass-through entities, which means they distribute most of their profits to shareholders as dividends.
Right, so we're getting that tax advantage again. And while BDCs might be a bit unpredictable in terms of dividend growth, REITs seem to have a better track record, don't they?
That's right. REITs often benefit from contractual rent increases built into their leases. Plus, real estate values generally tend to appreciate over time, which can lead to dividend growth.
So with REITs, we're aiming for that sweet spot of income and growth potential, all backed by tangible assets.
Exactly.
Which REITs are we eyeing for this portfolio?
Qs stand out in this context. WP Carey, ticker symbol WPC, and BSR REITs traded under Home U in the U.S., or BSRTF over the counter.
All right, let's start with WP Carey. What's their story?
WP Carey is a global net lease REIT with a long history of success and a broadly diversified portfolio.
Okay.
They own a mix of industrial, warehouse, retail, and office properties. What's interesting is their focus on essential businesses.
Essential businesses. That sounds pretty recession-proof.
It certainly adds a layer of resilience, and their dividend yield is currently a healthy 6.3%, comfortably covered by their cash flow with a payout ratio in the mid-70s.
That's good to know. And they have a BBB plus credit rating, which suggests financial stability, right?
You got it. Plus, they have a long history of raising their dividend, typically at a low to mid-single-digit rate annually.
Okay, so WP Carey brings a mix of income, moderate growth, and stability.
What about BSR REIT? What makes them unique? BSR REIT is interesting because they focus on multifamily properties, specifically Class B apartments in the Sunbelt region of the United States.
Class B apartments, Sunbelt region. Why this specific focus?
Class B apartments tend to be more resilient during economic downturns compared to higher-end luxury apartments.
Oh.
They offer a more affordable option for renters, so their occupancy rates tend to hold up well even when times are tough.
So it's a play on affordability and stability within the housing market.
Precisely. And BSR REIT operates in high-growth markets, which bodes well for the future.
Right.
Their dividend yield is currently around 4.4%, but they recently increased their payout by over 7%, indicating a strong commitment to returning value to shareholders.
Interesting. A bit lower yield than WP Carey, but potentially stronger dividend growth potential.
Right.
It's a nice contrast. All right, 2 down, 3 to go. What's the next category we'll be exploring?
Next, we're going to dive into the energy sector, but not in the way you might expect.
Oh.
We're going to focus on midstream MLPs.
MLPs. Those are master limited partnerships, right? They have a reputation for being a bit complex.
Yeah.
Can you break it down for us?
You're right. MLPs can be a bit more intricate than your average stock.
Yeah.
But at their core, they own and operate the infrastructure of the energy industry.
Okay.
Think pipelines, storage facilities, processing plants.
Gotcha.
These are the behind-the-scenes players that transport and process oil and natural gas.
Uh-huh.
And that's what makes them so attractive for this portfolio.
Okay, so they're essential for the energy industry to function.
Yeah.
But what makes them a good fit for this specific retirement strategy?
Their defensive nature. They have long-term contracts with energy producers,
Okay.
which means their revenue is fairly predictable regardless of the short-term fluctuations we often see in oil and gas prices.
So they offer stability and insulation from the volatility of the energy market.
Exactly. They also tend to be resistant to inflation as many of their contracts have built-in adjustments for rising prices.
So they offer stability, inflation protection, and a pass-through entities. They offer those high yields we're looking for, right?
Right, again, that's why we're including them in this portfolio.
Okay, so midstream MLPs bring a unique combination of benefits. What specific MLPs are we highlighting today?
We've selected 3 for this portfolio. Enterprise Products Partners, ticker symbol EPD,
Okay.
MPLX, and Western Midstream Partners, WES.
All right, let's take a closer look at each one, starting with Enterprise Products Partners. What makes them so appealing?
EPD is a giant in the midstream space.
Okay.
They're known for their conservative management approach, their vast pipeline network, and an incredible track record of consistent dividend payments.
Impressive.
They're currently offering a yield of around 7.2%.
Wow.
And they have a history of steadily increasing their dividend, typically around 5% annually.
That's impressive. They sound like a solid anchor for this portion of the portfolio.
They are. They also have a very strong balance sheet and plenty of liquidity, which provides an extra margin of safety.
Okay, so EPD checks all the boxes. Stability, consistent growth, and a solid yield. What about MPLX? What sets them apart?
MPLX is another major player in the midstream industry.
Okay.
They focus primarily on gathering, processing, and transporting natural gas and natural gas liquids.
Got it.
They offer a very attractive yield of 8.2%
Wow.
and have set an ambitious target of 12.5% annual distribution growth.
Wow, 12.5%. That's a bold target.
Yeah.
But are those growth projections realistic?
Well, to be conservative, we're assuming a more modest growth rate of 7% in our calculations.
Like,
It's always wise to temper expectations, especially in a cyclical industry like energy.
makes sense.
Yeah.
So MPLX, high yield, strong growth potential, but a bit more risk to consider compared to EPD. What are Western Midstream Partners? What's their story?
Western Midstream Partners, or WES, is our third pick. They primarily operate in the Permian Basin, which is one of the most prolific oil and gas producing regions in the United States.
So they're right in the heart of the action.
They are,
Yeah.
and they offer a hefty yield of 9.5%, the highest of the 3.
Hawaii.
They recently increased their distribution by 50%, and while we don't expect that pace to continue,
Right.
they should be able to sustain a growth rate of at least 3% going forward.
Okay, so WES offers the highest yield of the bunch, but potentially comes with a slightly higher risk profile.
Right.
All right, we've covered 3 categories so far: BDCs, REITs, and midstream MLPs. That's a lot of ground covered.
It is.
What's next on our list?
We're going to shift gears from traditional energy infrastructure to something a bit more forward-looking. Renewable energy infrastructure.
Renewable energy. That's a hot topic these days.
Yeah.
How does it fit into a retirement portfolio focused on dividends?
Investing in renewable energy infrastructure offers several benefits.
Oh.
First, it provides diversification from traditional energy sources like oil and gas.
Gotcha.
Second, it taps into a rapidly growing sector with significant long-term potential.
Uh-huh.
As the world transitions towards cleaner energy, the demand for these assets is expected to increase dramatically.
So it's a play on both diversification and growth. What specific types of investments are we talking about here?
We're looking at companies known as yieldcos. These are publicly traded companies that own and operate renewable energy assets such as wind farms, solar farms, and hydroelectric plants.
So instead of investing in a solar panel manufacturer, we're investing in the companies that own the actual power-generating assets.
Exactly. And like the other categories we've discussed, yieldcos are structured to distribute a large portion of their cash flow to shareholders as dividends.
Okay, I'm seeing the pattern here. High yields exposure to a growing industry and diversification. What specific yieldcos are we considering for this portfolio?
2 companies stand out: Brookfield Renewable Partners, ticker symbol BEP, and Clearway Energy, CWEAM.
Let's start with Brookfield Renewable Partners. What's their story?
Brookfield Renewable Partners, or BEP, is a global leader in renewable energy.
Okay.
They have a massive portfolio that includes hydroelectric, wind, solar, and even nuclear assets.
Well, that's a very diverse mix.
It is, and that diversification helps to mitigate risk.
Okay.
They also have a strong balance sheet, a BBB plus credit rating, and the backing of Brookfield Asset Management, a global alternative asset manager.
So they have some serious institutional support behind them.
Yeah.
That's a good sign.
It is, and their current yield is around 5.6%.
Right.
with projected annual distribution growth between 5% and 9%.
So solid yield, strong growth potential, and a lot of stability thanks to that diversified portfolio. What about Clearway Energy?
Clearway Energy, or CWNA, is a bit more focused.
Okay.
They primarily own wind and solar assets with a smaller exposure to natural gas.
So they're more of a pure play on renewables.
That's right. They have a strong track record, a stable dividend, and a current yield of around 6.6%.
Okay.
Their projected dividend growth rate is between 5% and 8%.
Okay, so a slightly higher yield than BEP and a similar growth outlook. It's
Yeah.
great to see these options in the renewable energy space becoming increasingly viable for income-focused investors.
Absolutely. It's an important part of a well-rounded and forward-looking portfolio, especially for those seeking long-term sustainable income.
All right, we've covered 4 categories now: BDCs, REITs, Midstream MLPs, and renewable energy infrastructure.
Right.
We've assembled quite a collection of dividend-paying powerhouses.
We have.
What's the final piece of the puzzle?
The final piece is all about adding an extra layer of diversification and capturing a blend of income and growth potential through broadly diversified ETFs.
Ah, ETFs. Those are always a favorite.
Yeah.
What specific ETFs are we looking at to round out this portfolio?
We'll focus on 2. The Schwab U.S. Dividend Equity ETF, ticker symbol SCHD,
Okay.
and the JP Morgan NASDAQ Equity Premium Income ETF, JEPQ.
Okay, let's start with SCHD. What's the story behind this one?
SCHD is a very popular and well-regarded ETF.
Okay.
It tracks the Dow Jones U.S. Dividend 100 Index,
Okay.
which means it invests in large, well-established blue-chip companies with a history of consistent dividend payments and strong financial fundamentals.
So we're talking about the cream of the crop when it comes to dividend-paying companies.
Exactly. And because it tracks such a broad index,
Yeah.
it offers instant diversification across various sectors of the economy.
Makes sense. And what about the yield and growth potential?
SCHD currently offers a yield of 3.4%. But here's the impressive part. Its dividend growth has averaged in the double digits over the past decade.
Wow, double-digit dividend growth. That's remarkable.
It is, but to be conservative, we're assuming a more modest growth rate of 9% going forward.
Always good to temper expectations, even when we're dealing with such a strong performer. Okay, so SCHD, blue chip stability, attractive yield, and impressive growth potential. What about JEPQ? What does it bring to the table?
JEPQ is a bit more unique. It's an actively managed ETF that invests in companies listed on the NASDAQ Stock Exchange.
Okay.
But what makes it really interesting is its covered call strategy.
Covered call strategy. That sounds a bit complex. Can you walk us through it?
Essentially, it means that the fund managers sell call options on a portion of their holdings. This generates premium income, which boosts the ETF's dividend yield.
So they're using options to generate extra income for investors. Interesting.
Yeah.
What kind of yield are we talking about?
JGPQ's expected forward dividend yield is around 9.5%, which is very attractive. However, for our calculations, we're conservatively assuming no dividend growth.
Why no growth? I thought covered call strategies could generate consistent income.
They can, but those premiums can fluctuate quite a bit from month to month. So while JGQ offers an attractive yield, it's wise to be cautious on the growth front.
Got it. High yield, but potentially less growth, and a strategy that might require a bit more research to fully understand.
Right.
Okay, we've covered all 5 categories now: BDCs, REITs, midstream MLPs, renewable energy infrastructure, and diversified ETFs.
Yep. That's a lot of information and a lot of different investment options.
It is, and it really highlights the importance of carefully considering your goals, risk tolerance, and time horizon before making any investment decisions.
Absolutely.
Absolutely. We've laid the groundwork, explored the different categories, and gotten a sense of the potential these investments hold.
Yeah.
But how do we actually put all these pieces together to create a portfolio that can generate that $60,000 annual income? Now let's get into the nitty-gritty. How do we actually put those pieces together?
Yeah.
We've got all these exciting investment options, but how do we decide how much to allocate to each one? It's like having all the ingredients for a delicious meal, but no recipe.
That's a great analogy. And just like a recipe, portfolio construction requires the right proportions to achieve that perfect balance.
Right.
We want to balance income growth and diversification while also considering the individual's risk tolerance.
Right, because someone who's comfortable with higher risk might have a very different portfolio than someone who prioritizes stability.
Yeah.
So how would we approach allocating $1 million, assuming a moderate risk tolerance?
Let's break it down. First, remember that 15% we set aside for gold as our hedge against unexpected events.
Yep.
That leaves us with 85% to allocate across our 5 categories. Let's start with BDCs. Given their high yields but potentially limited growth, we'll allocate a total of 12.5% to this category.
Okay, so about an eighth of the portfolio is dedicated to those high-yield BDCs. And how would we split that 12.5% among the three BDCs we discussed?
We'll go with 5% each for MSDL and GBDC and 2.5% for OBDE. This reflects their slightly different risk profiles and potential for future growth.
So we're spreading the risk within the BDC category itself. Smart move. What about REITs? How much do they get?
For REITs, we'll allocate a total of 10% split evenly between WP Carry and BSR REIT at 5% each. This gives us exposure to both a globally diversified net lease REIT and a more focused play on Class B apartments in those growing Sunbelt markets.
A nice mix of different types of real estate and some geographic diversification as well. Okay, what's next on the allocation list?
Moving on to midstream MLPs, we'll dedicate a total of 20% to this category.
20%, that's a significant chunk. It really shows how important they are to this strategy.
It does. Their attractive yields and defensive nature make them a valuable addition to this type of portfolio.
And how would we divide that 20% among the three MLPs?
We'll allocate 10% to enterprise products partners. Given their conservative approach and long history of consistent growth, they'll be a solid anchor for this portion of the portfolio. MPLX, with its higher yield and potential for faster growth, will receive 7.5%. And lastly, Western Midstream Partners, with its higher risk profile but impressive 9.5% yield, will round out the category with 2.5%.
I like how we're strategically balancing those different risk-reward profiles within each category.
Yeah.
It's all about spreading the risk while maximizing potential returns.
Yep.
Now let's move on to renewable energy infrastructure. How much are we allocating here?
We'll allocate a total of 10% to this category, split evenly between Brookfield Renewable Partners and Clearway Energy at 5% each.
So a bit less than MLPs, but still a significant allocation. It shows how important it is to incorporate the growth potential and diversification that renewables offer.
Exactly. And finally, for our broadly diversified ETFs, we'll allocate the largest portion at 32.5%.
32.5%. That's over 30% of the portfolio. What's the thinking behind such a large allocation?
ETFs are incredibly powerful tools for diversification. They allow us to invest in a broad basket of companies across multiple sectors, which helps to reduce overall portfolio volatility. Plus, they offer that desirable blend of income and growth potential.
Makes sense. And how do we split that 32.5% between our two chosen ETFs?
SCHD, with its focus on blue-chip dividend growers and its remarkable track record, will receive the lion's share at 20% GEPQ. With its high yield but potentially less growth, will receive the remaining 12.5%.
Okay, so we've allocated our entire portfolio. Let's recap those percentages. 15% for gold, 12.5% for BDCs, 10% for REITs, 20% for midstream MLPs, 10% for renewable energy infrastructure, and 32.5% for ETFs. We've thrown a lot of numbers around. How does this all translate into that target $60,000 annual income?
That's the exciting part. When you take the weighted average of all those yields factoring in our allocations, this portfolio is designed to generate a target yield of around 6%.
6%. That's pretty impressive, especially when you consider that we've built in potential for dividend growth on top of that.
Exactly. Based on our conservative estimates for dividend growth across the portfolio, we're anticipating an average annual growth rate of around 4%.
So the income generated by this portfolio could potentially outpace inflation, helping to maintain purchasing power throughout retirement. That's a big deal.
It is, but it's crucial to remember that this is just a starting point, a blueprint.
Right.
The specific allocations and investment choices might need to be adjusted based on individual circumstances, risk tolerance, and financial goals.
Right. There's no one-size-fits-all solution when it comes to investing.
Yeah.
What works for one person might not work for another.
Exactly. That's why it's important to do your own research, understand the risks involved, and potentially consult with a qualified financial advisor to tailor a plan that aligns with your specific needs and situation.
This deep dive has given us a fascinating glimpse into how a dividend-focused strategy can be used to potentially achieve early retirement. But it's not a magic bullet.
You're right. It requires careful planning, diversification, and a long-term perspective. But for those who are willing to put in the effort, it can be a powerful path to financial freedom.
Okay, so we've got our portfolio structured. We've calculated our target yield and dividend growth rate. Now what? How do we actually take this plan and make it a reality?
That's the crucial next step.
Now let's talk about the exciting part, putting this plan into action.
Yeah, sounds good.
We've covered a lot of ground, but I'm sure many listeners are itching to know, how do they actually start building their own early retirement portfolio? What are those first crucial steps?
Well, the most important step, even before you start picking stocks or ETFs, is to thoroughly assess your own financial situation and goals.
Okay.
This means taking a hard look at your income, expenses, assets, and any debts you might have.
So it's all about understanding your starting point before you map out your route.
Exactly. You need to know where you stand financially and where you want to go, just as important as understanding your own risk tolerance.
Okay.
How comfortable are you with the ups and downs of the market? What level of potential loss can you handle without losing sleep?
Risk tolerance is so personal. There's no right or wrong answer, but it's crucial to be honest with yourself about how much risk you can realistically stomach.
Absolutely. Once you have a solid grasp of your financial situation goals and risk tolerance, you can start thinking about the specifics of building your portfolio.
Okay, so let's say someone has done their homework and is ready to start investing. Where do they begin? Do they need to have $1 million ready to go?
Not at all. A good first step is to determine how much capital you can realistically allocate to your early retirement portfolio.
Okay.
Remember, this is a long-term game, so it's important to start with an amount you're comfortable investing for the long haul.
Right, we're not talking about get-rich-quick schemes. This is about building a solid foundation for a sustainable retirement income stream.
Precisely. And once you've determined your initial investment amount, you can start allocating it across those different categories we discussed using the percentages we outlined as a guideline.
So start with a bit in gold for that safety net. Then allocate portions to BDCs, REITs, MLPs, renewable energy infrastructure, and ETFs based on your risk tolerance and individual preferences.
Exactly. And remember, you don't have to invest everything all at once.
Oh,
You can gradually build your portfolio over time, taking advantage of market dips or opportunities as they arise.
that's a great point. Dollar cost averaging investing consistently over time can be a smart way to reduce risk and potentially lower your average purchase price.
Absolutely. And as you build your portfolio, don't forget about the importance of diversification.
Right. We don't want to put all our eggs in one basket.
Exactly. Within each category, aim to invest in a mix of companies or ETFs to spread the risk and ensure your overall portfolio is balanced across different sectors and asset classes.
So even within the BDC category, for example, we wouldn't just invest in one company. We'd spread our allocation across several BDCs to reduce the impact if one underperforms.
Precisely. And as you monitor your portfolio over time, don't be afraid to make adjustments as needed.
Adjustments. What kind of adjustments might be necessary?
Well, market conditions change, companies evolve, and your own financial situation might shift as well. So it's essential to review your portfolio regularly and rebalance if necessary.
Rebalancing that means selling some investments that have performed well and buying more of those that have lagged to bring the portfolio back in line with the original target allocations, right?
Exactly. Rebalancing helps you maintain your desired level of risk and can potentially improve your returns over the long term.
So build a portfolio, gradually diversify across categories and within categories, and rebalance periodically.
Got it. Anything else investors should keep in mind as they embark on this early retirement journey?
One of the most important things is to stay informed and do your due diligence. This means keeping up with market trends, researching companies thoroughly before investing, and understanding the risks associated with different asset classes.
Right. Knowledge is power, especially when it comes to investing your hard-earned money. It's crucial to do your own research, consult with qualified professionals, and tailor your approach to your specific circumstances.
I couldn't agree more. We've covered so much ground today, from the power of dividend income to building and managing a portfolio designed for early retirement. It's been an incredible journey and a fascinating deep dive into a really unique approach to early retirement.
It has. Hopefully, our listeners feel empowered to take those next steps on their own path to financial freedom.
Absolutely.